Hey up guys, this is Patrick Cura, your prof next door, and for today's video, we will be discussing short-term financing.
So our discussion for today will pertain to short-term financing. But before we proceed, let us first compare your short-term financing with your long-term financing. So in here, as you can see, when we say short-term financing, it is typically having 12 to 18 months term. While when it comes to long-term, it ranges from 2 to 5 years term. Now, as to the interest rate, in short-term financing, it has a wavering rate. When we say wavering, it varies depending on the period that you get. While when it comes to long-term financing, the rate is fixed. Who provides short-term financing? You can obtain it from a bank or from lenders. While from long-term financing, you can get it from money lenders, bank, and other institutional investors. Now, why do you need short-term financing? It is used for short-term requirements and working capital. And as we have discussed in our general working capital management, when we say working capital, the formula is current asset minus current liabilities. For long-term financing, its usage is for long-term drives such as your capital investments, your risk management, and your upgrading of facilities. Now, let us define what is short-term financing. And there are two sources of short-term financing. We have unsecured short-term financing and secured short-term financing. Pag sinabi nating unsecured, ibig sabihin wala siyang collateral, wala siyang guarantee or pledge. While when we say secured short-term financing, it's the other way around. What are the categories of unsecured short-term financing, which we will going to discuss today? We have your credit, trade, or your line of credit, your bank loan, and your commercial papers. And we will also going to talk about factoring of receivables. Now, why do firms need short-term financing? The company needs cash flow from operations which may not be sufficient to keep up the growth-related financing needs. So, kailangan ng business yan para makapag-operate siya ng maayos. The firms may prefer to borrow now for their inventory or other short-term asset needs rather than wait until they have saved enough. So, your short-term financing is your spontaneous liability. No? Ang composition niyan is yung nasa current liabilities mo. We have two current liabilities as we have discussed. We have your accounts payable and we have your accruals. Firms may prefer short-term financing instead of long-term sources of financing because of the interest that it involves. Kasi mas mataas ang interest kapag mas mahaba yung period na kukunin mo. And let's go to the first short-term financing. We have cost of trade credit. Ito yung kapag nangutang ka dun sa mga suppliers mo, yung bibigyan ka niya ng credit terms. So it is an act of obtaining funds by delaying payment to suppliers. Ito yung madalas na nakikita mo sa problems sa financial accounting na bibigyan ka niya ng parang fraction, no? Yung 210 and 30, 115 and 60, etc. etc. So what is the formula for cost of trade credit? We have discount rate divided by 100% minus the discount rate, multiply it by 360 days over credit period minus the discount period. Remember that when you avail of the trade credit, there is an implicit cost of interest if you want to delay payment of the accounts payable for an additional number of days. So, for example, the business offered you trade credit of 210 and 30. Ibig sabihin nun, if you paid within 10 days, you will get 2% discount. While if you will pay within 30 days, you will get no discount or net of discount. Now, if you will not avail of the discount na 2%, it means you are availing of the extended period. So instead of 10 days, you can pay up until 30 days. However, if you will avail the additional period of the credit terms, it means there is an implicit cost na babayaran mo. Kasi remember, there's no free lunch. Babayaran mo yung paggamit mo ng araw na hindi mo kinlaim yung discount na binibigay ng supplier mo. Let's have an exercise. Yusin purchases merchandise for 200,000 and the term is 210 and 30. What is the annual cost of trade credit? Using our formula, let us plot. Okay? In the problem, your discount rate is the 2%, while your credit period is your 30 days. Your discount period is the 10 days. So it looks like this: 2% over 100% minus 2% multiplied by 360 days over 30 days minus 10 days. And then you proceed by 2% divided by 98% multiplied by 360 days over 20 days. So you will get 36.73%. That is the cost of your trade credit. Let's proceed to the next one, the cost of bank loan. So ito yung usual na na-encounter natin when it comes to short-term financing, yung manghihiram ka sa bangko. There are two kinds of cost of bank loan: without compensating balance and with compensating balance. When we say without compensating balance, you don't need to have an amount to hold in your bank account or savings account. So we can divide it into two, non-discounted and discounted. Pag sinabing non-discounted, hindi dinideduct agad yung interest. So the formula for non-discounted without compensating balance is interest divided by face amount. If it is discounted, the formula is interest over face amount minus interest. Now for the with compensating balance, if it is non-discounted, the formula is interest divided by face amount minus compensating balance. If it is discounted, the formula is interest divided by face amount minus compensating balance minus interest. Now, let's have an example. Kakilala company was granted a 200,000 bank loan with 12% stated interest. First question, it receives the entire amount of 200,000. So in here, alam natin na non-discounted siya kasi binigay ng buo yung inutang mo. And at the same time, because the problem is silent, it is assumed to be without compensating balance. So if we will plot, that's interest divided by face amount, 24,000 divided by 200,000. So my cost of bank loan is the 12%, which is my stated interest, right? And let's go to the next one. How about if I am granted with a discounted loan? Okay, so in here, you will deduct the interest in advance, and the assumption is without compensating balance. So the formula would be interest divided by face amount minus interest. So you plot it out. That's 24,000 divided by 200,000 minus 24,000. Simplify it. So that's 24,000 divided by 176,000, and you will arrive at the answer 13.64%. So mas mataas siya dun sa non-discounted. Okay, yung gastos mo sa discounted. Continuing, let's go to letter C. It is required to maintain a compensating balance of 10,000 under a non-discounted loan. So we will use the formula with compensating balance, non-discounted basis. So that would be interest divided by face amount minus compensating balance. So that's 24,000 divided by 200,000 minus 10,000. We simplify it, that's 24,000 divided by 190,000, and our answer is 12.63%. Fourth, it is required to maintain a compensating balance of 10% under a discounted loan. So the assumption here is with compensating balance, discounted basis. So the formula would be interest divided by face amount minus compensating balance minus interest. We plot it out, that's 24,000 divided by 200,000 minus 20,000 minus 24,000. Simplify it, that's 24,000 divided by 156,000, and you will get the answer of 15.38%. Okay? As you can see, pataas ng pataas, no? Habang nagiging discounted basis siya at merong compensating balance, tumataas yung cost of bank loan mo. Next, let's proceed to cost of commercial paper. When we say commercial paper, these are short-term unsecured promissory notes issued by firms with high credit standing. In short, not all firms can issue commercial paper. So you need to ask approval from a certain government agency before you can issue commercial paper. They will gauge your credit standing. And what's the formula for commercial paper? That's interest plus issue cost divided by face minus interest minus issue cost multiplied by 360 days divided by the term of the commercial paper. Let's have an example. Gagawin Company plans to sell 180-day commercial paper amounting to 100 million pesos, which it expects to pay a discounted interest of 12% per annum. It expects to incur 100,000 in dealer placement fees and paper issue costs. So we will use the formula interest plus issue cost divided by face minus interest minus issue cost multiplied by 360 days over term. We plot it out, that's 6 million plus 100,000 divided by 100 million minus 6 million minus 100,000 multiplied by 360 days all over 108 days. Now, how do we compute for the interest of 6 million? Your face is 100 million, right? Multiply it by the interest of 12%. So that is how much? 12 million. Now remember, the commercial paper is only 180 days. So in short, you need to multiply your interest by 180 divided by 360. So you will arrive at 6 million. Okay? So now let's simplify. 6.1 million divided by 93.9 million multiplied by 360 divided by 180 days, you will arrive at the answer of 12.99%. Lastly, let's go to cost of factoring. So what is the meaning of factoring? As you have encountered in Financial Accounting Part 1, factoring is one of the receivable financing, no? And in here, you will sell your receivables in a what? In a with recourse notification basis. Now, there are two formula. If deducted in advance, that's interest plus fees divided by net proceeds. And if it is not deducted in advance, that's interest plus fees over face minus reserve. Let's have an example. Gagalingan Company has 200,000 pesos in receivable that carries 30-day credit term, 2% factors fee, 6% holdback reserve, and an interest of 12% per annum on advances. Letter A, what is the cash proceeds from factoring receivables? So let's compute. How much is the face? The face is 200,000 pesos. You deduct the holdback reserve. Okay, that's 200,000 times 6%. You will get 12,000. You deduct the factor's fee, which is 200,000 multiplied by 2%. The answer is 4,000. And then you deduct the interest. How do we get the interest? That's 184,000 multiplied by 12% multiplied by 30 day divided by 360 days. Paano natin nakuha yung 184,000 na interest? That is by deducting the holdback reserve of 12,000 and factor's fee of 4,000 from your face amount na 200,000. Okay? So your interest is 1,840. Then your total proceeds is 182,160. Letter B. What is the effective annual financing cost of factoring? So, it is asking you magkano ba yung gastos mo dito sa pagpa-factor. And remember, I highlighted here the word annual. So, pag annual yan, yung multiply mo ng 12 months. Okay? Kasi remember, ang given natin is only 30 days. So, you plot it out, 4,000, which is your factor's fee, plus your interest of 1,840, divided by your net proceeds or the 182,160. So you will arrive at 3.205%. You multiply it by 12 months, you will get 38.46%. Now, bakit hindi natin dineduct yung holdback reserve? Because that is not a cost of your factoring. It is a receivable from the factor. So, marireceive mo pa din yan kaya hindi yan kasali sa cost mo. So, before we end our discussion, let me leave you a thought for the day. We have every decision you make in business has a financial consequence. Okay, so I hope you learned something from our video today, and don't forget to subscribe, like, and share. Okay, guys.